Good afternoon and welcome to the March 2018 edition of the Bull and the Bear Show. Very glad to have you with us and very glad to be joined by a good colleague and friend of mine, John Kumarianos, who has worked for Morningstar for quite some time analyzing investment returns and also a very prolific contributor on sites like Market Watch and the Wall Street Journal. And you can find his work at Real Investment Advice blog. Great place to find his thoughts. And we have a couple questions for him. Let's just jump right into the Bull and the Bear show for this week. The bull, the bear, and the steer, right? John's going to talk to us about the steer, kind of the unknown. The bull is still earnings. If you look at earnings, we've had a very strong earnings season reporting for the fourth quarter of 2017. And here's a couple of nuggets, right? The highest revenue growth since the third quarter of 2011. The highest earnings growth at 14.8% since the third quarter of 2011. And a record high level of the percentage of companies beating their revenue estimates. And the earnings surprises above the 5-year average, and the earnings per share beats above the 5-year average. So, it's not just politics that's making the market move. It's not, tax reform. It's actual earnings. That's at the end of the day what drives investment returns. We can get right into it. If you look at the fourth quarter, earnings per share up 14.8%, revenue up 8.2%, and in the tech sector up 22.6%. Consumer discretionary up 9.5%. Why do I mention those last two? Because in our portfolios, we've been overweight exposure to the tech and consumer discretionary sectors, and that's had a very positive effect on your returns in your investment portfolio. So double-digit earnings growth is expected to continue in 2018. Negative earnings per share guidance is well below the average for the first quarter. So what that means is the table setup looks good going ahead as well. When that changes, we'll let you know. I'm not a perma bull, I'm not a perma bear. We're driven by the data. When the data changes, we'll let you know and we'll change. Let's talk about the bear, which is taxes. That means taxes are coming down. That's a good thing. Remember, 36 days from today to file your taxes. And let me not forget to remind you, the gift deduction in 2017 returns is $14,000. You can give $14,000 away to about as many people as you want until you hit the $11 million estate deduction cap, I think. For HSA, contributions, if you have an HSA, you should contribute to it and max it out $34.50 a person. That's triple tax-free money. You don't pay taxes when it goes in, it grows tax deferred, and when you spend it on qualified medical expenses, you don't pay taxes. Triple tax-free. So make sure that you fund your IRA, $5,500, an extra $1,000 for $6,500 to catch up. Make sure you max out your 401k, 18 grand. If you're over the catch-up age, another 6,000 for you, for a total of 24,000. So taxes are going down, but you still want to beat Uncle Sam by maxing out your deductible contributions, okay? So with that, let's get to John. Let's talk a little bit about investor behavior, some of the things that people can do or should do to make sure that they don't get freaked out by the steer, which has really been, there's kind of added volatility. So, John, what do you think about investor behavior? What are some of the big mistakes that investors make when it comes to managing their investments?
So one of the biggest things, if not the biggest thing, is something called recency bias. Investors, and that means investors have the tendency to extrapolate or project what's happened in the recent past onto the future. Investors need to be careful about doing that because the human tendency is to do that. So right now that means being careful about probably being too bullish because we just celebrated the 9-year anniversary of the bull market. I think the market bottomed on March 9th, 2009. Right. So we just passed 9 years of really uninterrupted gains. We had some hiccups, I suppose, in the summer of 2011. The end of 2015, early 2016, and then a little bit in early February most recently. That seems like a blip on the screen already. But I would encourage investors to think about how they felt a few weeks ago in early February when the market lost all the gains it posted for the year at one point, and even a little bit more. There's something else that goes hand in hand with recency bias called the empathy gap, and that means investors have a difficult time remembering how they felt in a bear market. If we haven't had a bear market in a while, they also have a difficult time remembering how they feel in bull markets when we haven't had a bull market in a while. But that's not the case now. So if you felt like you had too much stock exposure in early February, you probably do. Talk to your advisor. It's a good time to do that because now we've had a recent hiccup. You don't have to remember all the way back to late 2008, early 2009 to mind that empathy gap, to remember how you felt. You have now a recent example of maybe not feeling so hot. And if your tendency was to sell stocks when the market was going down and not buy a little bit more, not to say that that was the bottom and you should have bought more, but if that wasn't your feeling, maybe you've got too much stock exposure.
Right. That's a great way to analyze it. So if when the market had a pretty big correction in late February, so what you're saying, John, is that if you felt like, oh man, I'm afraid maybe you have too much stock exposure, the opposite of that would have been if you were confident to go in and buy that dip, that means you're probably allocated about right.
That's right. If you were at least playing cool and not really feeling the tendency to do anything, that's okay too. Best thing to want to do is have a bias towards buying when the market goes down, but that would be the best thing. But if you didn't feel like doing anything, that's good. If you felt like selling, that's probably a bad sign that you're maybe a little misallocated.
Right. Now, John, didn't recently a Nobel Prize was awarded based on behavioral finance? That's correct, right? Last year?
Oh yeah, so we've had two in recent years. Robert Shiller a few years ago, and then from the University of Chicago, Richard Thaler won last year.
And why is this, just put a little skin on that for us.
So behavioral finance is a movement in economics that has grown up over the past few decades, and it's challenged the view that human beings are perfectly rational. We tend to be motivated by emotion more than we think. Robert Shiller is famous for saying that stories and narratives move markets and move investors, and sometimes make asset prices do crazy things. And so I think there's some truth to that. Benjamin Graham, Warren Buffett's teacher, although he lived before the time of behavioral finance, was very much in tune with the pitfalls individual investors make. He said the greatest enemy most investors have is themselves. I'm paraphrasing there, but that's pretty close to the direct quote. So mind your emotions, make sure your allocation's okay, and understand that even though we haven't had a lot of volatility lately, first couple of weeks of February notwithstanding, it will come back, and you should be prepared. You should be prepared for it. What's happened most recently is actually not likely to repeat.
Right. Very good. That's why we had him on, ladies and gentlemen. That was a great answer. That was a $10 answer right there. So coming to you from Newport Beach at the Research Affiliates Portfolio Conference.
Advisor Confab.
Advisor Confab. John Kumanarios and Blair Applegate for the March 2018 Bull and Bear Show. Thanks for your time. Thanks for watching. We'll see you again soon. Take care.